Hi guys, we're still looking at FX risk, and just a quick reminder of where we are coming from. Remember, we're looking at finance risk, and I told you that this is divided into three. You have liquidity, you have market, and credit. Our focus is on market risk. Market risk can be price risk, can be interest rate risk, can be FX risk. And I also told you that we are not looking at price risk. We're only focusing on interest rate risk and FX exchange risk. And all we have been looking at so far is the FX risk. That's what we've been focusing on. And I've given you the three types: the transaction, the translation, and the third one. What was the third one? The economic risk. Yeah, remember, economic risk. Yeah, so this one is about buying and selling or lending and borrowing. And this one is about financial reporting revaluation. And this one is about foreign subsidiary. Yeah, and after that, also spoke about the way exchange rate can be managed, fixed, floating, and managed. And likewise, as explained to you in previous videos, how you can actually predict future exchange rate, talking about the likes of purchasing power parity theory, the interest rate parity theory, and likewise international Fisher effect. And I told you that the purchasing power parity theory is the strongest, and you need to know that the other two are poor predictors. Now, we've been talking about the risk. Are we just going to be looking at the risk? As a finance manager, we cannot just be looking at it. In fact, one of the major reasons why we are looking at this as a topic is because we want to manage this risk. So we want to find solution to this risk. That is why it's a topic. We want to solve it. The question is how? And the answer to that is by hedging. By hedging. So hedging is like a professional word for anything we do to reduce or eliminate risk. That is hedging. So hedging is a way of reducing or eliminating your risk. And there are two ways of achieving this. The first method is you can use external method or you can use internal method. When we're talking of external method, what you are using is you are procuring service from the bank. So you are using bank services. So the company is using bank services, or the company is trying to use derivatives. When I talk of derivatives, though we won't spend time on this a lot, this you will do in AFM more. Future and options. It's bank services that we're going to spend a lot of time, because here we'll look at the use of forward and we'll look at money market hedge. Yeah, we'll come to this, but let's quickly deal with the internal. Yeah, so when you are using internal method, internal approach, you are doing it by yourself. You are using your staff to do it. So the company is doing it by itself. So this one, company is doing this by itself. Yeah, its staff. The employees are the one doing it. They don't need bank. They don't need any external party. And what are the ways they can do it? You need to know the ways you can achieve internal edge. And I'm going to teach you 3 ways. The first thing you must do, if you want to do it internally, you don't want to be exposed to foreign exchange rate, you can invoice in local currency always. So invoice in local currency. So take for instance, you are in the UK and you want to sell a product to someone in the US. Don't invoice that person in US in dollars. Because if you invoice that person in dollars, that person is going to pay you in dollars. And you don't need dollar because you are operating in the UK. All your business, buying and selling, payment and receipt, is in mostly in pounds. So you have to convert that dollar to pounds if you collect dollar from the person. So, and that will exchange you to the exchange rate between dollar and pound. So the way to avoid that is to invoice the guy in the US in pounds, which is your local currency. And by that, you are not exposed. So you guys need to agree on what exchange rate will be on that day, and you issue his invoice in pounds so that you are not even exposed. There is no time lag between converting any money to anything. You are not exposed. So that's internal method. Another way you can use internal method is lead payment. Lead payment. And what does lead payment mean? Anytime you hear lead payment, think of immediate conversion. This is trying to avoid the time lag. It's trying to avoid that timing that I spoke about when we started this series, right? So take for instance, if I need to pay someone in dollars, if I'm buying it today, I'm converting my pounds to dollar today, and I'm just, even if I don't have to pay him today, I've converted that money to dollar. I just need to pay him anytime I'm ready to pay him. So there's no exposure for me in the next 3 weeks or 3 months or whatever, because I already have my dollar ready to pay him. And the best thing is just pay him immediately. Convert immediately. That's why it's called immediate conversion, and pay. And if anybody needs to pay you as well, collect the money immediately and convert. So there is no time. So this is trying to avoid that time that every exchange rate needs to fluctuate. So you are not thinking of what exchange rate will be, because you don't need to convert anything in the future. The third method you can do internally is what we call the matching. Some people call it netting, because what you are trying to do is to match income. Either you are matching income in foreign currency with expense in the same foreign currency, or you are trying to match asset in foreign currency and liability in that same foreign currency. So what we're saying here is that if you sell to someone in US and that person is owing you $100 million, make sure that you create expenses also in $100 million, so that whatever the exchange rate is doing on this, the opposite will happen to this, and the impact will be zero. So the net effect will be zero, because this is revenue, this is expenses. Okay, and same thing is applicable to asset and liability. So those are the internal methods, and it's not more than that. Now, where the major work is for us is the external method, and that is where the biggest part of this section G of the syllabus is external method here. Practically, a lot of people struggle. Even CFA students struggle with this. AFM people struggle. Yeah. But if you pay attention, you will be excited and you will be very comfortable. But please, whatever I'm going to be teaching you on this, I need you to stay consistent. Use it the way I have taught you every time you need to practice. Don't try to mix it. Don't try to do it all in a way you think it should be done. Just follow through my process. With this process, you will never miss it. It is 100% fail-proof. So please stay consistent. Remember, I said there are 2 ways for external method. Is that you are using a bank service or you are using derivatives. But our focus is the use of bank services. Yeah, which is what I touched on here. So those 2 things will be what we're going to be looking at. And the first one that we'll be looking at is the use of forward contract. Forward contract. And I'll start from the meaning. Yeah, I I always like to make you understand what are we talking about before we go into calculation. So anytime you have forward contract, please just know that forward contract is a contractual agreement. I know agreement is always between two people. You can't have an agreement with yourself. So contractual agreement between the company and the bank. And what is stated in the agreement? They are stating to have agreement to exchange specific amount of currency. Yeah? Specific amount of currency at another specific. So listen to all those specifics I'm doing. I've said one specific amount at a specific agreed rate. Doesn't end there. On a specific future date. Another specific. 3 specifics. So I put so much emphasis there because that is the key important thing you must know about forward. It is very specific. The amount is agreed. The price, which is the rate here, is agreed. And the future date as well is agreed. When you have these 3 things specified in a contract, what you have is a forward contract. And it's forward because it's in the future. So we've agreed what we will do in the future. But when did we agree it? We agreed it today. We are not waiting for the future. We are saying that in the next 6 months, for instance, I'll be selling to you $100 million at $1.2 per pound. That is the rate. And on 21st of December 2024, that's a future date. So that has satisfied all the requirements of forward, and that is a forward contract. So what are the general characteristics of forward? General characteristics. First thing you need to know that it is an obligation. So you don't have an option. It is not an option like derivatives here, which we're not go into details for this paper. Yeah, this one is an obligation, which means it is a must. It must comply. Once you sign it with somebody, you must comply, because if you don't comply, it is enforceable in the court. It can take you to court, and the court will mandate that you pay. If you don't pay, you will be asked to go bankrupt and your asset will be sold. So it's an obligation. You must comply. You must obey your terms. And likewise, it's over the counter. So it's not regulated. That's what this means. Over the counter. 2 people can one person can, a company and a bank can come together. 2 people agree what they want to do. So it can be a bespoke. It's flexible. They can agree the quantity, the date, the time, everything on their own and sign off. Or like if something is regulated, like if you want to buy shares, you go to a stock exchange market, there's a specific quantity, you need to use the price of the market. But these ones, they can agree by themselves and choose their price as they want because it's over the counter. And ladies and gentlemen, this is the perfect hedge and probably the best hedging method. The perfect hedge. Because when you use this method, you are guaranteed that you will not be exposed at all to fluctuation of exchange rates. You are 100% protected. Okay, those are the characteristics, and just to give you that overview of how we manage the FX risk. Now we need to go into the calculation, which is where students are so afraid of, but it is interesting. You will enjoy this one, right? So let's go into the calculation. And before I go into a lot of computation, I need to talk about currency quote system, because that is the foundation of getting your calculation correct. If your currency quote system is not properly understood, you will struggle with this part of the syllabus. So I am going to spend time on this. And the standard quote system, there's a standard which is the generally most common way of interpreting, and which whatever you are doing, because the other method, you must always convert to the standard quote system. The standard quote system is always that you have a rate, say 1.2440 to 1.2660. Then let's say you have $/pounds. This is your standard quote system, where you have the first rate is called the buy rate, and the second rate is called the sell rate. And you can see your buy rate is always lower because everybody wants to buy cheap and sell high. So your lower rate is always your buy rate and your higher rate is always your sell rate. And the difference between your sell rate and your buy rate, I know what comes to your mind, is profit. Yes, it is profit. The only thing is that we don't call it profit. Instead, we call it spread. So that is what is called spread. Right. So that is your standard system. And whatever system you have been given, please always convert it. And I'll teach you all the ways they can confuse you by not giving you a standard code system. But you must always convert it to the standard system. But let's explain the standard system first before I show you the other code system. Now, the critical part, in fact, the most critical part of this syllabus is how to interpret these codes. And that is what I want to say to you. So let's talk about the interpretation. As simple as it looks now, if you don't understand it like the way I want to explain it now, you might likely struggle. So please pay attention, right? And follow what I want to tell you. The first thing you must know, remember I've told you your buy rate is the lower rate, your sell rate is your higher rate. When you want to interpret your code, please interpret from bank perspective. Remember, this is transaction between company and the bank. So, bank always give the quote. Yeah? This is because company cannot give quotes. Company is not the owner of currencies, it's the banks. So because bank are the one giving the quote, so bank gives the quote. So you must always interpret. This is very critical. This is the thing that I'm talking about right now. This interpretation part is very important. You must interpret your quote from the bank perspective, right? Which means what you are saying is that this quote is coming from the bank. So it's the bank that is buying pounds at this rate or selling pound at this rate. The second rule that I'm going to tell you, see, these two things are critical because as simple as they look, if you don't use them to practice every now and then, you will struggle with rate interpretation. And I know what I'm saying. I have a lot of friends during my CFA that I had to teach this because they all struggled. And immediately they got this, they were extremely comfortable. So always interpret as well using the second currency. Please don't ever interpret using the first currency. Remember what I said? The currency they write first is always your first currency, and the one at the back is always your second currency. So two things you need to note is interpret using the bank perspective and second currency perspective. these are the two things that will determine whether you'll be comfortable with this part of the syllabus or not. If you do that, you will be home and dry. Now, let's now do the interpretation using this rule that I've given you. These two rules. You will see this in any textbook. You won't see this in any material. They explain it and you always get confused, right? But it took me some years to be able to, because I've always wanted to interpret things, explain things as easy and comfortable for students. So please, this is golden for you. Now, let's interpret this guy using these rules that I've given you, these two rules. So what we are saying is that we're going to interpret this quote using the second currency, which is pounds. Yeah, and like a bank, because it's the bank that is giving us the quote, right? So what are we going to say? What that quote is telling us is that bank will buy £1 at, this is the buy rate, $1.2440. Or you can say bank, remember we must always interpret using bank, will sell £1 at $1.2660. If you can do this, which is super easy, the way I've said it, you are 50% ready. And it doesn't get even difficult. It can only get easier. This thing that I've said to you is what will save you in this part of this forward transaction, even in money market edge, right? This interpretation is extremely important. Okay, now you know the interpretation. I told you most times they might not give you your quote in a standard format. The other ways they try to give you, and I want to expose them right now. The first they can do is they can give you, so let's look at other quote system. The first way they can give you is they use spread. So they might say $1.4/pounds plus or minus 0.001. This is spread that they have given you. Once they do that, what they are telling you invariably is that you need to add to something and deduct from something. They do this. They play with that plus or minus. Now the central number is 1.4, which is what they have given you. And you know that buy rate has to be lower and sell rate has to be higher. So once they give you like this, just know that you need to, the minus will be for the buy rate and the plus will be for the sell rate. So which means you will deduct 0.001 from 1.4, and that will give you buy rate of 1.399. So you add 0.001 to 1.4 to get your sell rate, $1.401 pounds. And that is your standard rate. Now you have your standard format that you can now interpret like this, which is saying that the bank will buy £1 for 1.399 and will sell £1 for $1.401. Yeah. If you deduct 1.01 from 1.399, that will give you 0.002, which is the final spread they will make if they do that transaction. Yeah. But they can give you this kind of format, plus or minus spread, like that. They can do that. And please take notes. Don't get rattled. Just convert it to your standard format and use it accordingly. The other way they can do it is to give you what we call currency discount or premium. Yeah. And what you just need to know about this one is they give you in a discounted form. If they give you a discount, just add it to the rate. If they give you a premium, deduct it. And I'll give you an example of what I mean. So just know this. If they give you a discount, add. They give you premium, deduct. Yeah. Take for instance, they might say spot quotes. which means today. So spot quote is 1.239. Yeah, just for an example, $1.246 pounds. That is quote, spot quote, and this is standard, which is fine. However, because you are working a forward and you need a 6-month forward quote, they won't give you the 6-month quote. They can say 6-month forward quote. Instead of giving you in a standard format like above, they will now say is 0.02 discount. Or they can say is 0.001 to 0.006 discount. Whichever they tell you, if they tell you like this, just add 0.02 to each of them. And if they give you like this one will go to this, and this one will go to this. That's all you need to do. So take for instance, if they give you one discount, then what you are saying is that is 1.241, yeah, to 1.248 pounds. That is what we're talking about here. Yeah. And if it is premium, instead of discount, then you deduct it. Yeah, if it is premium, if instead of 0.02 discount, it says 0.02 premium, then that rate will be 1.237 because you now deduct O2 from both of them. 1.237 to 1.244 pounds. So if it is discount, remember you add. If it is premium, you deduct. Yeah. And likewise, the same thing. If they give you in terms of this format, just know that each will go for the one on each side. But if it is one, the same thing for both sides. Those are the two ways they might try to confuse you.